I mean, imagine you walk onto a field, ready to play a sport you've known your entire life. You know exactly how points are scored, you know where the boundaries are, and, you trust the referee.
And then you score a goal, and the referee suddenly looks at you and says, well, the points are actually being measured in a completely different currency today, and the boundaries just moved about 10 feet to the left.
Which is exactly what the global economy feels like today, Monday, July 2026. A completely shifting playing field where the basic rules, how we value legacy companies when we decide to spend money, even how international sports are refereed, are suddenly highly negotiable.
They really are. The market mechanisms that felt completely rigid just a few years ago are warping. We are seeing them buckle under the pressure of, new technologies, shifting climates, and some very direct political interventions.
So our mission in exploring these sources today is to sort of synthesize this fascinating stack of market data and uncover how capital is ruthlessly reallocating itself across defense, tech, travel, and ultimately your own wallet. Let's actually start with a sector actively rewriting its valuation rulebook, which is defense.
A great place to start, especially with tomorrow's NATO summit in Ankara coming up.
Right, because ahead of that summit, the U.S. is aggressively pushing its European allies toward a massive target of spending 5% of their GDP on defense by 2035. But financial media and market strategists are pointing out a really fascinating nuance here. Capital isn't just blindly flowing into, legacy tanks and artillery.
No, it's not. The defense sector is experiencing what looks like a tech-like revaluation.
Over the weekend, Lockheed Martin agreed to buy the UK naval defense firm Ultramaritime for approximately $3.45 billion. And the focus of that acquisition is heavily on anti-submarine technology and electronic warfare rather than traditional hardware. At the same time, we saw Germany recently cancel its legacy F-126 warship program.
The cancellation of that F-126 program is really the crucial signal here. It tells the market that even in this era of exploding defense budgets, expensive, slow-moving legacy programs are incredibly vulnerable if they don't meet new artificial intelligence and drone requirements.
Which invites a pretty direct comparison to the early 2000s dot-com boom, where the definition of a quote-unquote tech company was aggressively expanded just to capture investor excitement. Slapping the label AI enhanced onto a traditional defense contractor looks suspiciously like a mechanism to justify much higher stock valuations, rather than, a genuine transformation of the manufacturing base. I have to wonder if a shipyard is still just a shipyard no matter how many microchips you put on the boat.
Well, the distinction between a genuine capability upgrade and a pure valuation marketing tactic is exactly what the market is trying to price in right now. Strategists are arguing that electronic warfare is fundamentally a tech phenomenon. So the companies building those systems should theoretically trade at the much higher multiples we usually reserve for software companies.
This obsession with AI isn't just inflating defense contractors, though. It's forcing pure, established tech giants to make brutal financial trade-offs. For example, Microsoft is immediately eliminating 4,800 jobs. That is 2.1% of their entire workforce, specifically to reallocate costs for the AI era.
The capital required to stay competitive in the generative AI race is just staggering. It requires liquidating other assets. The Microsoft job cuts illustrate capital reallocation driven by existential fear.
The Xbox gaming division is taking a massive hit there, losing 20% of its staff. They're also spinning off 4 gaming studios, including Double Fine and Compulsion Games.
Because Microsoft is not struggling for cash, investors are simply demanding to see that every single dollar is optimized for this AI transition. The Xbox division, which, has seen shrinking hardware revenues recently, is treated as an expendable asset to fund the data centers required for new models.
Simultaneously, artificial intelligence is becoming a literal weapon in a corporate Cold War. Industry reports show that by July 10th, Alibaba is banning its employees from using Anthropic's AI tools. This comes after Anthropic essentially accused Alibaba of conducting a massive distillation attack to illicitly extract Anthropic's underlying AI capabilities.
That dispute highlights the extreme fragility of intellectual property in this space.
So I need to pause on this distillation attack concept.
Yeah.
How does an AI model actually steal from another AI model? They aren't breaking into servers and downloading the underlying source code, are they?
No, it's more subtle than that. Think of it like a cheap diner sending an employee to eat at a Michelin star restaurant every single night. The employee orders the signature dish, takes meticulous notes on the flavor profile, the texture, the presentation, and brings all that data back to the diner.
So the diner is using those thousands of notes to reverse engineer a passable copy of the dish, completely bypassing the need to break into the Michelin chef's kitchen or steal the physical recipe card.
Exactly. In a distillation attack, a cheaper, smaller AI model bombards a highly advanced model like Anthropic's with millions of incredibly complex prompts. It then uses the brilliant, nuanced answers it receives to train itself. It is a highly sophisticated method of extracting the intelligence of a $100 million model for just pennies.
The dark irony of the current tech market is just incredible. These massive corporations are actively firing thousands of human workers to fund the development of artificial intelligence, while simultaneously accusing their international rivals of digital espionage to steal those exact same artificial brains. We are watching companies aggressively sweat their expensive assets to improve their return on investment.
And if you take that same concept of extreme capital reallocation and apply it to physical infrastructure, the travel sector is a perfect parallel. They are completely rewriting the calendar to keep their machinery moving.
Which brings us to the massive consolidation happening alongside this schedule shift. The UK budget airline EasyJet agreed in principle to a roughly $7.3 billion takeover bid from the U.S. private equity firm Castlelake, which sent their shares up 10%. Finding new margins is clearly the only way to survive that kind of private equity scrutiny amid this brutal jet fuel squeeze.
Fuel costs remain a massive drag on operating margins. So in response, airlines are fundamentally altering consumer behavior through what industry executives call the creep of the seasons. Delta and United Airlines are now flying massive wide-body jets to Europe well into the winter months.
Right, United extended its Newark to Sicily route all the way through mid-December. They're completely ignoring traditional summer seasonality. Now, part of the narrative is that tourists are fleeing the extreme heat waves baking Europe during the traditional peak months. But I have to push back on the romantic idea of shoulder season travel here. Sipping espresso in a quiet Italian piazza in November is being sold to the consumer as a brilliant lifestyle choice. But fundamentally, this is a spreadsheet decision. This is a pure capital efficiency play. Airlines simply refuse to let a $150 million asset gather dust.
You're entirely right about the math of airline financing. Those wide-body aircraft used for transatlantic flights feature premium lie-flat seats that command thousands of dollars for a round trip. A 9-figure asset carries a staggering daily debt burden. You simply cannot leave that kind of revenue-generating potential sitting idle in a maintenance hangar just because there's a little snow on the ground in New York.
They have to keep the plane generating yield to offset those spiking fuel costs and heavy debt loads. And before we look at how those energy costs are warping other legacy industries, just a quick note. If you want to explore more market mechanisms and deep context like this, you can always find Financial Candy, Brain Candy, and classic audiobooks at clarinhoratio.com.
So, as energy costs force airlines to adapt their entire operational models, the actual mechanics of global energy supply and demand are behaving in deeply counterintuitive ways.
Specifically regarding oil gluts. Despite recent sanctions relief, Iran is struggling to sell its massive oil inventory. And market data points to a very clear mechanism causing this backlog, which is their biggest customer, China. Chinese crude imports have plunged to levels not seen since early 2018 because the country is aggressively pivoting to green energy infrastructure.
Furthermore, the OPEC Plus cartel is actively surging supply. They're adding hundreds of thousands of barrels a day to their production quotas. So we have this complex supply glut, yet localized energy costs are still reshaping traditional industries from the ground up.
Look at UK tile makers, for instance. Energy accounts for up to a third of their manufacturing costs. The firm Wienerberger is currently building a fully electric kiln, powered partly by an on-site solar farm, to permanently escape the volatility of gas prices. Meanwhile, a heritage manufacturer named William Blythe is deliberately sticking to a 1920s coal-fired technology to serve a very specific historic restoration market.
The contrast between Wienerberger and William Blythe is essentially a perfect case study in divergent market survival strategies. Wienerberger is making a massive capital expenditure to decarbonize and insulate its balance sheet from fossil fuel price shocks. It is a pure volume and efficiency play.
While William Blythe is leaning entirely into the premiumization of inefficiency. By keeping a century-old coal-fired process, they produce a tile with physical variations in color textures that modern, efficient electric kilns just cannot replicate, which introduces a very healthy skepticism about the heritage label we see on so many consumer goods today.
It's a fascinating branding exercise, isn't it?
In modern economics, handmade or historic often functions as nothing more than a clever pricing mechanism. It allows a business to pass the massive cost of profound operational inefficiency directly onto wealthy consumers who are more than willing to pay for the romantic narrative of a 1920s coal oven.
And that tension between massive, efficient legacy players and niche, specialized upstarts is also completely scrambling the consumer automotive market. Managing energy transitions creates very strange consumer behaviors.
Over the weekend, Tesla posted strong second-quarter delivery numbers, beating consensus estimates. But the stock barely moved. The good news was already entirely priced into its massive $1.5 trillion valuation. Meanwhile, their much smaller competitor, Rivian, is launching its new R2 SUV, aiming directly at Tesla's bread-and-butter mid-market segment.
Analysts tracking this rotation are looking at localized data, something called the Holly Index. It captures the fluidity of consumer brand loyalty.
I've seen that metric. It's essentially a grassroots measure of shifting discretionary spending, where consumers rotate away from legacy staples toward new status brands, right?
Exactly. Just as consumers rotate from an established activewear brand to a trendy new upstart, they are demonstrating a willingness to rotate their automotive allegiance if a new brand offers a fresh status signal. Tesla's valuation dynamic shows what happens when a company transitions from a disruptive growth story to a mature incumbent.
Because at a certain earnings multiple, you can no longer surprise the market. The market demands absolute perfection just to maintain the current stock price. Speaking of fresh status signals capturing discretionary spending, Wegovy's once-a-day weight loss pill just became available privately in the UK. Pharmacies are pricing it between roughly $133 and $267 for a 30-day supply.
Which is a significant out-of-pocket expense for a daily medication.
It is, and both the Rivian R2 pre-orders and these private Wegovy prescriptions represent a fascinating consumer behavior. People are intensely willing to pay a premium for a highly specific lifestyle upgrade, even as broader inflation bites at their basic grocery bills.
Consumers will ruthlessly cut spending on traditional staples to afford a specialized SUV or a daily pill that promises a fundamental change to their physical baseline. The perceived return on investment for a personal health or status upgrade outweighs the friction of general inflation.
But financing those high-end lifestyle upgrades requires disposable income. And right now, the average consumer wallet is facing massive policy whiplash from the government. The rules governing personal debt and wealth accumulation are being rewritten in real time, creating vastly different outcomes depending entirely on your demographic.
The friction is intense. Millions of student loan borrowers are currently receiving notices that they have a 90-day window to exit the recently struck down Savvy repayment plan.
The mechanics of this transition are incredibly complex for the borrower. They are essentially forced to navigate a brand new menu of options, including the Repayment Assistance Plan or RAP. If they fail to actively choose a new plan within that 90-day window, they default into an expensive standard plan.
And defaulting into the standard plan carries the very real threat of wage garnishment if the higher monthly payments are missed. The burden of bureaucratic navigation is entirely on the borrower, with steep financial penalties for inaction.
Conversely, a brand new wealth-building vehicle just launched on July 4th, the 530A Trump accounts. Babies born between 2025 and 2028 receive a $1,000 government seed deposit. We are already seeing wealthy executives like SpaceX's President Gwynne Shotwell donating millions of dollars in personal stock to help fund these highly tax-advantaged accounts.
It's a stark contrast in policy mechanics. The 530A accounts are designed as frictionless wealth escalators. They combine direct-to-government seed money with private philanthropic matching, creating a vehicle that will eventually convert into a tax-free Roth IRA without the beneficiary ever filling out a single form.
If you are an adult listening to this, the friction in our current economic design is glaring. You are essentially being threatened with wage garnishment if you fail to navigate a bureaucratic maze of repayment acronyms, while a baby born tomorrow gets a frictionless tax-free grant from the government automatically. It all comes down to who makes the rules of the market and how easily a powerful intervention can completely alter those rules.
We assume institutions operate on fixed, impartial laws, whether that is the Department of Education or even a global sporting body. But recent events show just how malleable those laws become when direct leverage is applied.
Look at tonight's highly anticipated U.S. versus Belgium World Cup knockout match in Seattle. U.S. striker Folarin Balogun received a red card last week. Under standard FIFA regulations, that carries an automatic, non-appealable one-game suspension.
A rule that has been rigidly enforced for decades.
Yet over the weekend, a direct phone call from President Trump to the FIFA president, Gianni Infantino, resulted in an unprecedented reversal of that suspension. FIFA invoked a rare disciplinary clause to suspend the ban, allowing Balogun to play tonight. UEFA is absolutely furious, stating publicly that this intervention shatters the certainty, integrity, and credibility of the sport's global rules.
Because a market or a game relies on the participants believing the rules apply equally to everyone. When an external political force bypasses established judicial processes, the perceived integrity of the entire system fractures.
Which brings us to the core pattern emerging across all these sources.
Adaptability in the face of structural unpredictability. The players who are surviving and thriving, from defense contractors restructuring for electronic warfare, to airlines moving their peak seasons to December, to legacy tile makers selling inefficiency as a premium product, are the ones who realize the old rulebooks have been permanently discarded.
Connecting this all together, whether we are looking at tech companies ripping up their organizational charts to buy AI chips, or heads of state altering the foundational rules of a soccer match hours before kickoff, the institutions we previously thought were rigid are suddenly highly flexible. When all the traditional rules of a market become negotiable, the ultimate advantage goes not to the player with the most legacy power, but to the player who realizes they can simply negotiate a brand new rule. You step onto that field assuming the referee's whistle is final, only to discover the boundaries are drawn in chalk, and the chalk is in someone else's hands. Thank you for joining us as we unpack today's shifting landscape.